Hello, everyone, and welcome to this session on small finance banks. I'm Bindu Anand, and I'm delighted to be in conversation with CEOs of three of our leading banks in India, Rajiv, Sanjay, and Paul. We want to keep the conversation, as Arya mentioned, very much interactive. So we will definitely have time for Q&A. And in addition, I'm told that we will also have a few polling questions. So do look out for that. So let me dive in with that. The last 5 years have been a turbulent time for the Indian banking sector. In that landscape, I think SFBs stand tall, having successfully made the transition from NBFCs to banks, delivering superior ROAs and ROEs compared to other commercial banks in the last 2 years, and really building out what we all thought would be the hardest part of it all, which is the successful franchise in liabilities. Today, we have a wonderful opportunity, thanks to this summit, to go behind the scenes with these CEOs and understand really the blood and tears behind this journey. And additionally, I also want to explore from a policy perspective, is there indeed a differentiated business model emerging, as was the expectation for SFBs? Or is it, on the contrary, evolving along the same lines as private sector banks? So that is sort of the second part of what we will explore. I want to start really by asking, because it's so rare to get a chance to directly hear from the leadership, but I want to start by asking each of our panelists to reflect on the journey so far, roughly the last 5 years, and share with us in 5 minutes or less some key moments, milestones that really stand out for them as they think about it. Paul, if I can start with you, please.
Thank you, Bindu, and thanks to Access for hosting this panel in this year's Financial Inclusion Summit. And even during this pandemic, they were able to organize this summit on a virtual mode. So that itself needs a lot of applause. So as all of us know that the COVID-19 pandemic has really taken us the entire globe on a backseat now. So over the last 25 years, a recent World Bank study reveals that the progress on the poverty as the growth phase has slowed down significantly. So, and they're projecting around 88 million more people will be added to the the group, property poor group. So in this context, actually, the banks like us have a more relevance. I feel that small finance banks, that these experiences has got more relevance. And if I look back last 5 years, yes, definitely. The first moment was the 2015 September when the announcement came. That was a joyous moment for all of us. We were in the list of selected 10 banks. That was first. Then the second was mainly the launch date, launching a bank in a very limited time. So we launched the bank in 2017, March 10th, we launched the bank. So that was two significant events. So then the whole the transition process from an MFI to setting up a fully regulated, highly regulated bank was it was a really challenging journey last 5 years, but it was at the same time very satisfying for me and the entire reserve team. It was really a satisfying moment for us. And in 2018 December, we got the scheduled status. We became a scheduled small finance bank in 2018, and the first 100 branches converting the old microfinance branches to full-fledged regular branches, and achieving that first 100 branches was a great milestone for us. Then we got the membership in the Global Alliance on Banking on Values. We are the first bank from India to become member of the Global Alliance on Banking on Values. So, and one thing that last 3 years after we launched the bank, so we couldn't dilute any of our mission. So we continue to focus on our mission. And another great milestone was that on the launch day itself, we were able to open bank account for all our existing customers, microfinance customers. Yes, it was. If you ask me whether it was a prudent decision on a financial terms, it was not. But on a social banker, it gives me a lot of satisfaction. We were able to give them say, a bank account and a debit card. And another challenge, most of the MFI migrated SFBs were facing that how do we manage the liability because we have to all the migrated grandfathered liabilities were there. How do we pay out? How do we mobilize? We are new, but that also by completing first year we got the confidence that we can we continue to give a differentiated service, differentiated rates we offered, and our doorstep banking service, our experience in the MFI as a doorstep service provider really helped us to we continue to give a doorstep banking. So today we have 8,200 crore liability book. So and last 3 years, I never, last 25 years before launching the bank, every year the major concern was the liquidity. Every time it was a pressure on liquidity. And so now that problem was solved. We have access to public deposits. A lot of many other options were also opened up. And also, if we could double around 200% of growth in the customer base, and even on the asset book has grown around 40%, from 1,900 crore to 7,200, 7,400 crore today. So over the 5 years, that was a great achievement without facing much challenges on. And we get, I said, we continue to bank with our customers. And as our tagline says, joy of banking for everyone. So we made air-conditioned premises for even including our micro-banking customers. And in 3 years, all the another major achievements, if you ask me, I could convert all the regular commercial bankers to a social banker or a differentiated banker. Many of my colleagues joined from many private commercial banks were convinced about the model of banking with the focus on social transformation and economic transformation, and on the they could see it and they could experience it. So that was some of these last 5 years journey I conceived.
Thank you so much, Paul. And we will come back and I think probe more particularly around the liability success story. Rajiv, if I can come to you next, some quick reflections on the 5-year.
Yes, thank you, Bindu. Thank you to the Access team for organizing this digitally. It's so good that we can still have this in current times. I would say, firstly, a very strong similar overlap the way Paul described the journey. Most of the SFBs have had those key milestones, getting the in-principle license, working through the whole conversion process, converting to final license, and then launching it. A big element at the time of launch and after the launch is obviously technology. So, and obviously hitting various milestones like schedule status, conversion of our branches, getting our deposits to be nearly equal to our credit. So therefore getting to a very good deposit ratios, creating liquidity for the bank, when your liquidity is starved. So when the digital side of it, you keep on adding some great things and bringing out things which at least today a lot of customers are used to, and a bank which is new does not have all those features on day one. Sort of concept level, very similar to what Paul described. I'll just talk of Bindu used the word blood and tears in building the bank. It's been now nearly 5.5 years since we all got the in-principle license, and I would echo what Paul said. It's been a very tough journey. It's a very hard-working journey, in terms of the amount of work that goes behind to get this thing to work and accelerate things. We are all we are all running existing organizations. There were assets, so you have to build liabilities. The expectations are very high. The market is looking at you, even if you're unlisted, the market is looking at you and saying, is this model going to be successful? The regulator is looking at you and saying, hey, is it a good thing that I've done? Is it a not so good thing that has happened? So I think the way it was set up, I think our own expectations of what we think we are capable of doing and what we have done in the past doesn't matter, but the future matters. So I think it's an extremely high hard work. As I said, very high expectations. The third thing I would say, it's a very intellectual phase, because there are no ready answers for a small finance bank. The big commercial banks are operating in very different markets and very different segments. So you can look for some answers on compliances, some answers, on a few bank processes from them. But when it comes to products, customers, a lot of the answers have to be very customized. What works for a big bank doesn't work for a small finance bank. So, when we sort of, even today, it's all about what is the gap between a larger vision and how do we cover that gap, and what are the right decisions we take to cover that gap is a very big key part of the intellectual thinking. So overall, and we'll answer some of those questions, I think the asset strategy, the liability strategy, the tech strategy, the people strategy, I think 4 big building blocks which had to be addressed. And we are far better off at the 3rd year point, 4th year point that we are all at. But the journey is a little longer, and there's a lot of work still to be done. But great outcomes. So pleased that all the 10 SFBs have done well. The format of the bank is very strong. It serves a significant objective of what we had, as a converting entity, and I think what the regulator has, what the government has, what the customers have, and because it's a great format, I think all 10 SFBs have proven good success out of this conversion.
Thank you so much, Rajiv. Sanjay, over to you. Any surprises in the last 5-year journey? You're on mute, Sanjay.
This is...
Yes.
No, is it fine?
Yes.
So, yeah. So I'm not a techie guy, right? So, Bindu, thank you so much. Access, thank you so much. In the interest of time, I would echo what Paul Saab and Rajiv just told about the whole narrative around SFB. And our journey remained a little bit different from most of the SFBs because we were more into the other product than a microfinance. So entire piece of getting licensed, the conversion, the technology, the people, remain same. But, being an NBFC with a lot of assets around wheel, SBL, home loan, and but I would say bank has actually surprised us as a platform, actually surprised us with this width, length, and deepness. What we were doing as an NBFC, now when I go back and visualize my last 20 years and last 5 years in comparison, then I feel that I was doing nothing as an NBFC, honestly, because the kind of hard work, the kind of overall leadership traits you require to handle a bank platform is immense, and we've not been, studied like this or not been coached like this. I'm a first generation entrepreneur, right? So the environment is teaching us every day, whether it's an environment of regulator, the environment of the government, the society, the customer, the employee, the technology, every day there is a new challenge. But I'm very happy to, say after, this is close to now 15th quarter of our journey as a bank, what we have achieved as in close to 2 million customers, now we are around 20,000 employees with around 800 touch points, and we are growing by 30-35% in all respect, whether it's asset or liability. We are actually putting a lot of effort on digital, which one initiative or one thing which separates you from NBFC to bank is only technology, honestly, because of course deposit franchise you can't do there, but the CEOs has to understand technology. If you don't understand technology, you will be far behind. So the whole payment structure, the whole engagement initiatives, the customer interaction, the customer reach, all is happening through digital. So we are very happy the way we have built ourselves in last 4 years, because we were zero as an NBFC on a technology front. And now we are having a 24/7 kind of call centers, the engagement, the internet banking, mobile banking. We're about to launch credit card. So very happy to see and actually explore myself as an individual on this platform. And I'm very thankful to RBI to give us this opportunity, honestly, because in life you won't get this kind of opportunity to run a bank. And milestones always, my one milestone might be different from others, because we got listed in 2017 itself, and now is close to 3 years. So I have one more added pressure, which is quarter to quarter, is to reply to the investors. So other than that, Bindu, enjoying this ride, enjoying this roller coaster ride. Honestly, I won't say this is a very plain ride. So you don't know when you go down and when you go up. So, but enjoying every moment of it.
Thank you so much, Sanjay. And certainly sounds like it's been an eventful 5 years and exhausting for all of you. But lovely to hear the perspectives. For the remainder of this conversation, I want to explore in depth really 3 dimensions of SFB performance that I think as a group we all care about. The first is outreach and cost to serve. Second is building the liabilities franchise. And the third is diversification of the loan book. And what I will do is I will share some data points just to set context, motivate the discussion. And then I'll ask each of our panelists to help us understand the story behind the numbers in the context of their own organizations, but also the SFB industry in general. So for that, I'm going to now try and share my screen. I hope this is visible to everybody. Let me put this on full screen. So it's a little bit of a crowded graph. Let me take a minute. So this is what you see is a picture of outreach, i.e. spread of the branch network as of January 2021. Each of the bars represents a category of bank types. So the first one, SBI and its associates, get a bar of their own, of course. The second is nationalized banks, so on and so forth. Arya, were you trying to say something? Okay, I'm going to keep going. And on the rightmost side, and hopefully this is visible to you, are the newest kids on the block, small finance banks and payment banks. And I thought it'd be helpful to look at this in a single graph so that we see where do the new entrants vary, where do they actually mirror incumbents. So if you look at the gray bars, which is the proportion of branches in rural areas, and each of the color coding represents a market. So gray is rural, orange is semi-urban, brown is urban, and green is metros. So if you look at the gray bars, which is rural, no surprise there that that is dominated by SBI and public sector banks. For SFBs, as of Jan 21, about little less than 20% of the branches are in rural areas. And surprisingly, payment banks, that number is only 5%. If this were a panel on payment banks, we would dive into that in a lot more detail. But the other thing that I want to point out, and then invite Rajiv to come in and talk about the branch kind of story, is that if you look at the small finance bank bar and the one right next to it on the left-hand side, which is the private sector banks, that actually looks pretty similar. That was one of the things that jumped out at me when I looked at this bar. So Rajiv, if you can maybe start with that, is that by design, or do you have really a different branching strategy in mind? Over to you, Rajiv.
Bindu, I'm not surprised it looks quite similar, except for the few differences which are also very obvious. But let me try and explain the similarity, and then I can explain the differences. So, at the rural level, the numbers are quite similar because we all broadly, firstly, we are trying to achieve our rural banking target of 25%. There are other kind of formats also which can achieve it. So therefore, it's not exactly 25, but private sector banks, small finance banks by nature are, and these are unbanked rural centers. A lot of them are unbanked rural centers, and therefore they're somewhat similar. A bank like ourselves, and I have a feeling that similar to others also, we service rural customers, but we don't necessarily put up rural branches. We are a 95% rural bank on our loan side, and we are really happy and proud of the fact that we are a rural bank. But it doesn't necessarily mean that we have to put a physical infrastructure in the tier 5 and tier 6 towns. So sometimes people miss the fact that lack of rural branches doesn't mean that small finance banks are not rural banks in terms of the customer base, especially the microfinance-led banks. So therefore, most of our infrastructure will lie in tier 1, tier 2, tier 3 towns. Our branches will lie in those towns, whereas the rural is defined as tier 5 and tier 6. Some of those the branches are out there being used for meeting our necessary requirement on the unbanked rural centers. So therefore, that number matches, which is somewhat similar to what the big private sector banks are doing. As you see, the other critical difference is actually the big difference is the other side, which is the metropolitan branches. The bigger banks, by their 20 years, 25 years of existence, and I'm talking about the private sector bigger banks, and the fact that they are super strong and super focused on their retail franchise in the bigger cities. So they have a very deep branch network to cater to the customers in the big cities. And all of us small finance banks, one, do not have a business model to start with on the significant business model in the pure metros, and two, to sort of compete with the big universal banks head on and put up a similar number of branches is not something which is economically viable in the short term or a wise strategy. So therefore, all that we have done is we put necessary infrastructure out there to bring the brand, to bring the reach, and to service the customer a certain way. But we're not competing with the big private sector banks in terms of distribution reach, in terms of branch network. So you will see a wide difference. They will have a significantly larger proportion in the metropolitan areas, and small finance banks will be relatively far smaller. The big focus of the small finance banks is in the semi-urban areas, and as you can see, that is a larger block. It just matches with our customer segment. It matches with what we are doing in the earlier past. So clearly, it is targeted to the way all of us were doing business, where we see a huge future growth potential, and it mirrors private sector banks in a somewhat manner. But there is a big difference between the metro focus and the rest of the segment and the semi-urban focus.
That's really interesting. Thanks, Rajiv, for interpreting. And this point around, many of your customers are rural, but the branch network does not necessarily reflect that. Mr. Thomas, if I can turn to you and ask you about your thoughts on the channel strategy, but also if you can speak about how important are business correspondents, what are the non-branch strategies that have worked well for you?
Yeah. Overall, on the branch strategy, I agree with what Rajiv said. So even though, because we were all, when we were in MFI, we have opened our branches close to another bank branch, because we have to bank, we need to have the banking service access. So that is why when we convert, those branches are still in urban areas. But overall, if you take in our case in ISAB, we have a 77% of our branches are in semi-urban areas, and with a specific focus on unbanked rural. 25% is mandatory, but we always maintain around 30% plus branches are in unbanked, and many places, even in Kerala, we initially thought that there will not be any village available to open a branch, but we could see. If you go to interior Munnar and all, you could see small branches of ISAB bank there. But from the day one, we also have adopted a strategy for a business correspondent strategy also. So Indian microfinance or micro banking services sourcing and servicing, from day one, we did through our business correspondents. So today we have around 13 business correspondents spread across different states. And apart from our 520 banking outlet, there are 196 customer service centers fully managed by the business correspondents. So we wanted to use that channel, and from day one, the launch date onwards, we have adopted that channel. I think now all the other small finance bank also now appointing that BCs and adopting that channel. So going forward, we see that channel will grow because because setting up a bank branch needs the cost is very high. So that 40 if an urban branch costs us 45 lakhs to the initial setup cost. So to make it break even viable takes time. So instead of that, so you can start with a partner. So we are going with a partner. They already have a customer base. So we can start a business. Then later, if there is a possibility, potential, we can open branches. And many of you, if you see the graph also, almost similar to the private sector banks, or metro branches are also, because in India, the larger deposits, the liabilities lies in the urban areas, cities, metro cities. So we have to focus on the metro branches. But again, metro pure liability, we have to still evolving asset products suitable for the metros. So going forward on the channel perspective, I am foreseeing BC as a channel will grow, and the digital, standalone digital channel, because till the COVID, we believe that our set of customers, the majority of our micro banking customers, they always need a assisted digital. So from day one, we had a tab banking model. It's an assisted digital model. But the COVID pandemic proved that 30% of our customers started using their customer initiated digital also. And when we do a demographic study among our customers, around 30% of our 50% of our customers comes under the 20 to 40 age group. So that also they are more tech savvy. So that digital is possible. So digital, even including financial inclusion and the micro banking segment, digital as a channel will grow. So we are also started investing on building up our own digital channel. So,
well, if I can ask you roughly, what percentage of your overall transactions are digital? Roughly.
As of now, it is only the disbursements are completely on through 100% bank through bank accounts, but repayments still on around 90% still on cash. Because the rest only around 10% they use bank transfers for making the repayments. So we need to, if we effectively wanted to bring these customers, the target, the micro banking customers to digitize their cash, their income has to be brought to the banking system. Then only
the source needs to be digitized. Absolutely. Thank you so much, Paul. Sanjay, turning to you, your thoughts on channel strategy. Also, specifically wanted to hear from you on OPEX and cost to serve from your NBFC avatar to bank avatar. How much has it changed, and which of it is a channel-related story?
Yeah, Bindu. So, before talking to, speaking around our branch strategy, we all need to understand the whole design principle around SFBs, right? Because SFBs are supposed to do 50% loan lesser than 25 lakh. Our priority sector requirement is 75. Our branch has to be, unbanked branches around 25%, but we all do around 30%, right? And we all need to raise deposit to do all kind of financial inclusion, because Bindu, I personally believe that you have to do first loans to do financial inclusion, right? You can't expect people to deposit money in the rural or maybe more hinterlands of the country, because they don't have money, right? They have to generate money, correct? So And in all my passing remarks, I always say that, SFBs are Robin Hood model, right? So we need to take money from HNIs because they only have the money and have to distribute into the people who really underprivileged or people who are into the ruler and all those stuff. So our strategy are two things, right? Because as NBFC, we remain into this lending model, and we were into this semi-urban and rural areas. So that is the old franchise of AU. But as you know that we need money, so we always we keep focusing on the metropolitan or the urban centers. And I believe that every SLB, they have to time themselves, but they have to come in urban to raise deposits, right? Because there only people will start believing that you are actually a bank, right? So we remain around, 30% our branches are into urban centers or a metropolitan, 70% remain into core markets, which we say about semi-urban and rural. But if this 30% urban and metropolitan branches give us 70% deposit, right? The core market only gives you 30% of deposits, right? And in terms of our asset, it's 50%, right? So we have to keep investing in our branch outlay, whether it's physical, virtual. And as Paul always mentioned that BC can be a new area, but it's not easy. It's not easy to govern BCs. They have their own challenges. But I have strong feeling around the digital distribution, and by allowing video banking now, so. In urban centers, SFB can become more effective if they use more video banking, because then you don't need a large branch setup with large capital outlay. You rather can put video banking in Mumbai or maybe Delhi, maybe Bangalore, maybe Calcutta, where you can have 2-3 setups and do all kind of engagement, acquisition, service, with the customer through video banking. So digital can be a big change in our strategy as we move forward in terms of our distribution. Other than that, I strongly believe that next 10 years it will go hand in hand, right? Because it can't replace, one model can't replace the other model. So for next 10 years, I believe that we as an AU will keep on investing on our urban centers, we'll keep on working on our rural centers, because that's our core for our working. And we'll also build through digital, right? In terms of cost, Bindu, because as I already told you that the cost on NBFC was very less, because we neither have invested in our branches, neither on technology, neither on people. It was more of a rough kind of model where, we would be sitting at 4th floor, back room, without technology, without connection, all those stuff. But you as a bank has to play some character, right? You have to build some kind of image around you. Otherwise, people won't trust. And if people don't trust, you won't get money, right? If you don't get money, how you lend it, right? Sure. So you need to keep investing in our branches, your outlook of your people, branch.
Sanjay, is there a data point you can share with us? Completely understand that NBFC Avatar was different.
Yes, sure. So cost to income, before a bank was around 30-35% cost to income, right? Now is around 55%. And I don't think that it will going down very sooner, because you have to keep investing in the every 3 aspects, which is people, technology, and branches.
Sure.
And cost to service, which is also high, because you have to pay people more, you have to use technology, there is an attrition, there is a competition. We are not very stabilized as a franchise where people will stay for long, right? So the cost is high, but I think because we have an added advantage, because our lending rates is also high, so we can actually protect our name. So I'm not too worried about cost, because you can play on our lending rates, you can play on your cost of funds, and build your around somewhere, right? But yes, ROA has dipped from NBFC, we were in 20% plus ROE. Now we are close to 15%. But that's good enough, because for sustainability, right? I strongly believe banking franchise is more sustainable than an NBFC franchise.
Sure. No, thank you so much for that, Sanjay. That's very helpful. And we've been talking a lot about liabilities, so I want to sort of go into that next. Hold on a second. And it's really, to the point that Sanjay was making and what he calls the Robin Hood strategy. That's an interesting way to talk about it. That there is sort of, one leg in rural and one leg in urban based on the product. So want to explore the liabilities question a little bit better here. So here is some data on the spread of deposits. I hope you all can see this. On the left-hand panel is the number of deposit accounts, and on the right-hand side is the value metric, the amount outstanding in deposit accounts. And so, this is all SFB, and this is March 2018 and 20 comparison. So if you just focus on March 2020, so Metro's account to the story that you all have been saying for more than 50% of deposits, and metros plus core urban centers together is 80% of the story. So this clearly speaks to this sort of I'm going to target this market for liabilities, whereas my core kind of lending group continues to be what I was doing earlier. So I want to go around again and sort of get a sense of, do you see this continuing into the future, particularly given the rising competitive intensity for metro deposits? More universal banks are going to get licensed, more pure digital players are going to come into the market. How do you see this liabilities sort of story evolving over time? And do you think, for example, semi-urban, which is currently 16% by value, 40% by number, is that going to be a bigger part of your story? Paul, if we can start with you.
Yeah. I think going forward, this is going to change this semi-urban. In our experience, it is because we have only 8% of our branches are in metro. Our majority of our branches, 77% of our branches are in semi-urban area, and majority of our deposits around 75% of our deposits comes from the semi-urban branches, and 95% of our deposits are retail deposits. So I think from the metro, the focus on the metro or concentration of the metro, because maybe the urbanization in India is also increasing. So more number of small towns will become urbanized. So more the semi-urban usage. From my experience, I'm seeing that the peripheral areas in a city you take because a lot of middle class is moving towards that, and the growing middle class is going to have more disposable income in their hands. So maybe I recently read a projection by 2050 there will be 78% of the Indian population will be the lower and middle income in the segment. So this LMI segment will both our asset business and both legs comes from this segment. That's my gut feeling, I would say. And my experience today proves that because we have around 75% of our deposits comes from 200 and plus 50% of our semi-urban branches. And some of the rural branches are also contributing very good in the deposits. But on the microfinance clients per se, and the deposit mobilization still to take a real momentum on they have accounts, but still they start with they depend on the loan. So we started a weekly along with their loan, they can pay a small amount. A weekly recurring deposit product we recently launched and it's getting momentum. And we need to do a lot of innovations in that space. And on the there are many innovations happen in the asset side in India. But unfortunately, on the liability business product development, not much has happened in India. Specifically for because the same product which we are offering to a metro customer is we are offering to a rural customer may not work. So we may have seasonal products all that may be required, and also the differentiated service, differentiated rates, differentiated service is required. So we offered a differentiated. All of us, most of the SMBs offer a higher rate of interest because our lending rate is also on the higher side. So we offered a higher rate of interest, so we could attract a good chunk of deposits from even from the first year itself. We could attract, and especially there are a large number of pensioners and senior citizens. So they need differentiated service also. So we, especially in our case, we offered a doorstep service. We organize special events for honoring old age senior citizens. We have a project called Vayomitram. Things like that we launched. And also another perception about private sector banks, they charge a lot of hidden charges are there, because when we launched the bank in 2017, there was a lot of discussion about charges, hidden charges. So we waived most of the charges from the day one. So that also helped us to mobilize a lot of deposits. But to build a CASA, we are only 15% of our deposits are in CASA now. That is also majority, even 90% of the CASA comes from savings account only. So the current account deposits building up take time because they need a lot of other services, other product to offer. So we're growing, and for us a lot of around 30% of our deposits comes from NRI segment, because our majority of our customers branches are in Kerala, and Kerala is a highly. But as I said, Sanjay earlier, banks needs a lot of investments in branding because it needs. We need to get trust. In last 20 years, we have been trusting people and giving unsecured loans. Now people have to trust us, but there is a story we can sell, and we launched a product for their deposits along with their financial returns. We share the social returns, the customers whom we serve, the data of the customer, and the social impact we create through that money. So we share with the depositors. So that really people appreciate that. So maybe we need to continuously innovate in this space.
Fabulous. Lots of interesting insights there. And I think want to underscore your kind of observation that we need a lot more innovation on the liability side. I think that's largely happened in the informal sector. If you look at the chit funds, the pygmy schemes, but they've all been in the gray sort of informal sector, and it'd be fabulous to see SFBs drive innovation also on micro deposits. Sanjay, turning to you, you've had breathtaking success on the liability side, but also particularly being a small business focused SFB as opposed to the other MFIs. Is current accounts a bigger part of the story? Have you done any product innovation on the liability side?
No, I think my colleagues would agree that the most toughest job in the journey of banking is to raise deposit, because actually every customer, when they ask, why should I bank with you once I have a relationship with, I actually have 100% confidence that, you don't have any account with your SFBs, So why Bindu doesn't have account with us? So everybody asks us, why we want to bank with you. Correct. So,
my father though is very interested to open an ESAF bank account, and I've encouraged him to do that.
Yeah, Bindu, and that's the reason is because he is more mature, right? So he trusts us. You don't. So and because I hope ESAF is giving him around 7%. Right? So it's very clear cut, strategy where you need to be very, very creative around creative. I would say very, very imaginative around your working to attract deposit. The first foremost thing is trust. And you can't buy trust, you can't inject trust, you can't even tell people that you trust me. It has to come very, very automatically, very subtle in a long way. That is why we always say that a bank is a journey, not a destination. And I have one strong belief that, in a previous days, once, people like HDFC and ICICI started, they took long time because people need to see their seasoning and they see their product, see their offering, they see their how they actually survive in the testing time. But now, we are very lucky that in a digital world, the flexibility, the convenience, the security, the easiness, the imaginative, it can be a next trust. So, for example, I'm just giving you one example that, people might not be trusting Amazon or e-commerce 10 years back because they always believe that the product might not be right, the service might not be right, or they might lose their money. But now in 10 years, everybody is believing that Amazon, all those people are good enough. So I believe that digital will be the biggest equalizer for us, if we play our inning well or play our ball well, right? So we need to be very imaginative, and at AU we have done a lot of things. We have actually segregated our market from core to urban. Urban, as I told you, has little bit differentiated way to handle it because their people are high end. They require a lot of service, engagement, priority. And honestly, Bindu, deposits are very commoditized. You don't have that very scope other than the rates. It's highly regulated, right? So whatever I can offer, the HDFC Bank will also offer. So it's about the delivery rather than the product. So I would say we are really working on delivery, which is the seamless, which is easy, which is because we are also young, we have that we can bend ourselves, and we are more hungry, we have more purpose. So that's the way we are handling it. But I think a lot of method in madness, like go to urban, let's not build quantity, let's build quality. Let's be more engaging, let's be more engaging in the right communication, right? Like once we want to communicate with your father, right, it has to be very different way that we communicate with you. So I think there we can play a differentiation role. So I would say liability is a journey, right? We need to keep on working on our whole of imagination around product, delivery, communication, engagement, brand, digital transformation, so that's the only way we can build a liability. But I'm very happy the way we've done till now, because being an SFB, because small word is also not helping us. And because generally people, and what happened to so many financial crises in last 3-4 years is also has not helped us. Whatever any bank happened, you always question SFB. And people generally ask you that you can't take high deposits, or how you are secured, why you are small in return. So a lot of questions being asked to our team on the ground. So it's required a lot of seasoning, but we are very happy that because as NBFC we never able to do that, right? So I think we are working on both the aspect, is the execution of NBFC and the trust of bank. So we are fortunate that we have both.
Sanjay, your core, the MFI kind of customer base, I think the general view has been that their surplus and their ability to kind of meaningfully save is limited. Your core customer has been the small business. What is your sense of that customer's potential from a savings perspective?
So we also started with the wrong notion that our asset customer, our loan customer will deposit the money. So these are two different two different people, two different verticals. So as of now, we have close to 30,000 crore of deposits. So it's just 10% is coming from our asset customer. And as you, sorry, you asked me about current account is more tougher because it's more tougher.
It's tougher, sure.
Because now the payment system are so quick.
Sure.
Why, and everybody understand that why he want to keep a money in the current account where you can't get any amount. Right? So people are actually in individual account. People generally keep floating the money within saving to current, right? And the money is available at your will, 24/7 RTGS. You can transfer internet banking, mobile banking at your will, right? So people are hassle free. So float in individual accounts are very less now, and the corporate accounts we can't go them because they require a lot of brands, they require a lot of loans which we can't give them. So current account is more tougher, but of course through the UPI, through the other payment methodology, you can make some easiness around your payment system. or you can actually hold the system and then enjoy, right? So these two things, was a mixed wrong notion which we built at the start of the bank. But now we are very clear that deposits a very different animal, and you need to keep on imaginating around your needs and the customer needs, and then build on. So you have a lot of patience. You need a lot of patience to build a deposit franchise.
Thank you,
And
Sanjay.
once it's built, Bindu, my colleagues know.
Sustain it, yeah.
Then you can enjoy for next 500 years. Maybe some other people, but that's our philosophy. So we are doing all that hard job. वहीं पर हमारा खून और पानी और आंसू सब वहीं जा रहे हैं, So.
Right. No, and I think the results of that are quite visible. I think none of us would have guessed that in 5 years, you could move the needle so much on liabilities. So that's, I think, really been heartening. And also, I mean, it also tells you something about the Indian urban consumer, middle income consumer, that everybody thought that those markets are very well served, and it'll be impossible to get somebody to switch from a public sector bank. But I think the openness that is being shown to bank, and including my father, who is super conservative, I think that's really been surprising to see that sort of openness. And I guess, people are conscious about price and rates matter. So the price-led strategy has, put you on the radar of the urban consumer, which is, I think, super interesting. Rajiv, quickly to you.
Can I give father number, please?
Yes, Sanjay. Oh, yeah.
One customer for access. Because of my 90-minute labor with you, right? Can I get it?
That's the least we can do to compensate you. So great. Rajiv, over to you on your thoughts on the, how is this evolving? Are you also, do you think the metro first strategy will continue?
Sure. So at the outset, there are always very similar thoughts, but let me just bring out two flavors, and both Paul and Sanjay alluded, and this also goes to your metro-led strategy. Clearly, the deposits are largely concentrated in the metro/the urban areas. So we are not changing the dynamics of it. So there is a lot of deposits coming from those areas, and it in a longer vision of the bank, when you put about 10, 20 years, we would clearly want to match our asset centers and our asset strategy and a deposit strategy, so that you have a more complete branch and a more synergized set of customers that you're working with in a branch. So it is not a long-term destination to have a lot liability-led branches or a lot asset-led branches. The difference is too stark right now for obvious reasons. So when we think 10 years to 20 years forward, I think we'll get closer to that. But in the short term, in spite of our best effort, and for the reasons alluded by Sanjay and Paul, the kind of disproportionate effort that you'll put in to get to a higher mix in the semi-urban or rural areas will not justify that effort when you're doing a lot more to build out the short-term liability game plans at the right cost to serve and everything. So in the short term, I do feel more aligned to a little bit of Sanjay's, and frankly, Kerala is very different. Kerala is pretty much, we can call it all metros or all urban. So maybe Paul's example has to be taken a little differently. But when you get to the rest of the country, Kerala is very unique. So it's actually Kerala and rest of the country, you can call it that way. You have to be a lot more invested in the metro and the urban branches for your deposit strategy. Otherwise, you'll have short-term challenges. Nobody disagrees with a 5 to 10 year forward view. The second point which Sanjay made on the customer overlap, of deposits and liabilities. Now, it's a very interesting point. Actually, it's an insight point, and it's not about. I would go back and challenge that a lot of the bigger banks would not also have a very big overlap, because it's a principle. Once a customer takes a big loan from you, he's very likely to be a very small saver with you, because customers do not have, they can't service a 15-20% rate on one side and earn 5% on the other side. So typically a customer, leaving out small loans here and there, somebody could be a small auto loan and be a big saver on the side, which is a small point in a larger bank context. Typically a customer in their life cycle is either a loan taker or a deposit creator for the bank. and the cycles change, and we ourselves have gone through the cycles. So it is not that all urban customers are deposits creators, and so therefore there is what the bank, a successful bank will achieve is when in a customer segment you are agnostic. You say, look, I deal with 100 salaried customers of this company, and in some phases some of them will be depositors and some of them will be asset takers, and they might switch between them, but my strategy is to work with the same set of customers in a complete value proposition, and they will change roles along the way. So the strategy is aligned, the positioning is aligned, a lot of things are aligned, but it is not necessary. And data of most of the small finance banks, what Sanjay said, and even when you go to the universal banks, I would say there may be a 10-20% increase in asset customers holding deposits, but it cannot be, a segment of customers could be equal, but it's not the same customer who would be having large amount of deposits. So it's quite rational out there. And an example, somebody takes a mortgage loan, he will never be a depositor with you because he doesn't have that much liquidity to match a mortgage loan. Those were from the two insights that were brought out. At a conceptual level, deposits, the pricing is a key play in there, and I can talk about that, but fundamentally it needs a reach. You cannot raise deposits without a reach. And all customers, when we talk of trust, the one of the big variables in trust is, can you see a branch? And if a customer can't see a branch, he can't trust you. Whether it's especially senior citizens, the youngsters can take a call on opening accounts on the net. But also remember the irony, as bankers, in the recent past, you learned the money also lies a lot with the senior citizens. The money doesn't lie with the youngsters. So if you're after the money, you should be after 60-year-old plus, 50-year-old plus. If you're after 20, 30 years old, they are spenders, they're transactors, they are probably loan takers, but they're not depositors. For 100 set of youngsters, 100 set of senior citizens, I'm telling you, you'll get 10 times the money from this. And the youngsters want to invest in stock market, mutual funds. They have alternate desires. The senior you say, I want to be conservative in my investment decisions. So again, the focus towards senior citizens is not a bad. All universal banks have that for their deposits, and small finance banks, because they were so focused as a deposit strategy, they went towards senior citizens. So one, branches are key. So reach is key. It is not like you need hundreds of branches, but you at least need some minimum number to create the trust and for your employees to work from and the customers to work from. The second one is, I would say, when you get customers, they don't just walk in. Frankly, our teams that we have hired, quite a few of them have had relations with the customers. So the initial contact with the customer is the key. It's not easy to get a cold calling done and somebody will trust you with their money. So I think building a good team which has past relationships or can create good relationships. It's a very deep hard sell. It's a very, you have to sell from your heart. It's not easy to just say, trust me. So a lot of work has to be done. It was alluded by Paul in terms of activities. Sanjay does the same thing. But just trust has to be built over a point of time, and opening relationship with customers is a material importance. It just helps make the whole sale process simpler. The third one that you talked about is a rate. I would say without a rate, your door will not even open. You offer a similar rate, they'll say, look, I trust HDFC Bank more, ICICI Bank more. Why should I take a risk on a small finance bank? Luckily, in a business model, we can afford to give a slightly higher deposit rate, and therefore there is a degree of sustainability in our strategy. So rate is a door opener. Without a rate, you cannot just, the whole deposit strategy will not work. And the last thing I want to talk about in that is technology. Technology plays two roles. If you are a paper bank, the customer doesn't have the time to create papers for you, fill out forms for you. They'll do it for the bigger banks. They'll do it for a PSU bank. Why should they waste their time and energy doing it for, getting a little bit of a pricing advantage from a small finance bank? So technology is the key, and technology is not just for convenience. Technologies also help build trust. In today's context, if any one of us can open an account for the customer doorstep in about 5 minutes, can you imagine the amount of impression that we create? If you can open your account in 5 minutes or 10 minutes and make it a fully operational account, we must be really capable. We cannot be a fly-by-night operator because these things don't happen that easily. So I would say technology for the convenience factor of it, and also the criticality for the trust factor of it. So when you put all these variables together and you just keep on working on it, it takes a little time. It is a lot of time. It's a journey, as Sanjay said. Somebody will work, somebody will reap the rewards. So, but fundamentally, it takes time. But I think with a pricing advantage, we can build it a little faster. And if we don't need to build it that fast, we can obviously slow it down by reducing the pricing differential that we offer. So we have the ability to sort of, moderate it up or down depending upon the need of the bank.
Right, Rajiv. There's some fascinating customer insights and a good reminder that it's not quite the same customer who is, kind of double hatting a saver or borrower. There are multiple segments. And I think the whole senior citizen story has been an unexpected good outcome of SFBs. I mean, I'm sure RBI didn't think that was going to be one of the social impacts of SFBs, but I think, you found a nice opportunity. And, as Rajiv, you said, rate has opened the doors, but then beyond that, it's really all the hard work of making a good impression, that you're reliable players, that you have physical network. And so I think winning trust takes you on that whole journey. The final kind of deep dive I want to do with all of you and then open it up to the audience is on the loan book. And I think there we have, a little bit more variation than the liability strategy. So this is the picture in the green bars are 2018, the orange bars are 2020, share of microloans in the overall portfolio, and this is different SFBs. AU stands out as having never done microloans. If I look at ESAF, for some reason I don't have your numbers. Maybe Paul, you can speak to that. But it's still, more than 90% of your overall loan book. For FinCare, it's declining rapidly, but still about 80%. So if I can turn to this question now, starting with you, Paul, how do you see this evolving? Do you think different SFBs are going to specialize on the loan side as well? Will somebody like you, for example, continue to be a microloans dominant player on the asset side?
Yeah, for me, I think do what you know, focus on what you know better. So that is a strategy we have taken, and on the asset side, our strategy we have taken is that grow with our customers. And their aspirations. So we'll become a family bank for our micro banking customers. So there we have given a microfinance loan to the women, to the lady. So her husband needed a three-wheeler loan. So we are exploring those options. And then as their income levels going up, so my micro group loan, they graduate to a micro enterprise loan, which we have created a 3 to 5 lakh rupee loan. Then a next phase of MSME, defined MSME loan. So I'm seeing that, and there is a huge potential for that market. And that segment of customers, we know them very well because we have gone through multiple cycles of challenges and take it, demonetization, flood, Andhra crisis, all this, we have gone through all these set of crises and we are confident of that segment. So we continue to focus on that segment. At the same time, and it's a diversification for us, we see it as a byproduct. So we started with my group loans. We introduced a individual micro enterprise loan and an MSME loan. And the same customers asking two-wheeler loan, car loan, home loan. So we started all these products. So today we have almost 90% of our loan is on group loan and 10% is on the other loan. And another loan we started is we have the branch network, and gold loan is very popular among, especially in the markets where we operate. So we started the gold loan, and gold loan is growing fast. Gold loan book is growing. So that's one area we will be. So as our capability, internal capability building is also very important. So as our risk-taking abilities, the team building will happen. So we'll slowly diversify. That is our plan.
That makes a lot of sense. So really kind of follow the customer and complete that cycle of needs. Rajiv, turning to you, that's still a pretty important product for you. Somebody once told me that, microloans, ATMs, we know that they will eventually disappear from the landscape. But when is the $1 million questions? It could be, the next 5 years, it could be the next 30 years. These things have a long tail. As you look to the future, is microloans an important part of your asset strategy? And what's number 2 and 3?
Sure. So just on the lighter side, I think I can still see ATMs disappearing at some point of time, the way our payments have ramped up in various ways. Microloans, I think things change. They may change formats. They may not be called microloans. They may become individual loans. There is a lot of unmet demand. So microloans as a microloan strategy will not change over the next 5-10 years. There'll be some changes, but I think in this format, they can still survive a decade. And beyond the decade, as the affluence picks up, there can be other forms of loans. And as Paul said, once you start adding other products, they'll move towards an individual loan, but the customer segment might still be the same, till the income disparity goes down and they really come up these strata, which can take decades. So at least the way we think, this industry has been in existence for the last at least 20-30 years, at least 20 years very actively in the country, 30-40 years outside. So it's a very long cycle industry. It's seen multiple cycles out there. So we are quite comfortable in believing that this product will be an important product for the bank for the future, for the next 10 years also. Now, the question is, what is the right mix? The bank should diversify, not because microloans is a bad product. Sometimes people ask this question of context, this is a problem. You have 80% microloans, so COVID happens, so you have a problem. If something happens, you have a problem. In theory, it's a concentration risk. So I'll explain to the concentration risk, but has microloans to be proved to be so bad in the last 10 years when you look at long-term averages and look at the losses and you say, what's been worse than personal loans, worse than credit cards, worse than something else, and you come back and say it has been much better. And if you look at COVID phase, when you look at the first few months of coverage, microloans is the biggest risk out there. And today you see microloans has probably the highest collection efficiency, probably after affordable housing. It has a higher collection efficiency or a reasonably high collection efficiency. So I would say diversification or reducing microfinance on the balance sheet is not about moving away from the belief that it's a bad product or a high risk product. It is because of the key thing, what everybody calls diversification. A bank sits on depositors' money. And when you sit on depositors' money, you have to run the institution where you can almost, with a very high degree of confidence, certify that the depositor's money is safe. The capital that the bank has enough cushion to absorb any risk on the loans that the bank has done. Now, if you have a concentration risk of any kind, it could be of personal loans, it could be of housing loans, it could be of any kind. Then you start becoming risked. You're not diversified enough for making that statement. So diversification for a bank is critical because that is the responsibility that you have to discharge as a bank. Because of the depositors' money. When you are an NBFC, you have equity and banks have lent to you with open eyes, where the depositor is not giving money to you with a thinking. It is your responsibility to diversify enough. So we have to diversify enough, not walk away from microfinance because, it's a higher risk and we should run away as fast as we can. It's actually one of the safer products as I look at in a long history of the product. Now, what is the long-term destination? The first clear destination for MFI converted banks is to reach a 50% mark, and we should reach there sooner than later. And the second one, I think, a core product of a bank, typically speaking, when you look at it, is about a 30-35% of the bank's balance sheet. So when you look at the banks, typically it's mortgage, but you wouldn't be surprised if a bank has 20% or 25 or 30% as one core product. So I would say if we are good at what we do, we believe in the product, there is no reason to bring it down lower than 30 odd percent or 35 odd percent in the long term, unless dynamics change, product behavior changes, the need changes, as you go forward 5 to 10 years. And the alternate products, we have started doing, loans, SME loans, we can call it loans against property. We do affordable housing, we do two-wheelers, we do gold, but in lending, you have to be careful where you lend, because you have to build the risk expertise, you have to build the collection infrastructure, you have to select the customers well. The value proposition has to have a positive selection of customers, not just the worst customers in the market. So because of the responsibility of good management of losses, we have to build it carefully. Speed is not of essence in a loan book buildup. It looks good in the short term, but it can hurt you very badly. So you have to believe the speed that you are at is the risk you are capable of managing the risk at that speed also, and therefore it will take and microfinance is not slowing down. So I always say to people that to get to a different percentage, either microfinance has to be artificially slowed down, or you have to grow faster than the microfinance rate. So if microfinance grows at 40%, the other products have to just go faster. So it takes time to diversify. So in a nutshell, I think we'll get to a 50% alternate products and maybe about a 60-65% over the next 5 to 10 years. But it's going to be relatively slower, 5 to 10% swing every year. And we will get there by doing the other products sensibly, because we understand microfinance and we are very good at it. And we also understand the other products, but when you're a new market, new player, you have to play the risk very well. You don't want NPA creation on your bank.
Absolutely. I think that's very good thinking. And I think when we talk about the microloans, 100% agreed with you that risk-adjusted returns have been quite superior. There's been a lot of event risk. But then if you look at it over a longer period, even 18 months post-events, collections are robust. Because the other thing we think about is also, will consumer behavior change in fundamental ways? With more urbanization, are people less likely to show up in groups and maintain the same affiliation? That's the other dimension that one thinks will change over the next decade. But great to see that it will be an important part of your journey. Sanjay, turning to you, I actually don't know much about what your loan book looks like, so maybe you can share with us. I remember 8-10 years ago, you visited us in Tanjavur to say, I want to understand how this gold loan business works. I'm sure you've done a cracking job of it. But what is the composition of your loan book, particularly since you are a small business focused player?
Yeah, so on a data side, we are around 40% is around wheel. In wheel we cover everything from two-wheeler to 20-wheeler, right, from commercial, personal, captive, taxis, whatever, right? So we cover everything on wheel. So which covers 50%, 40% of our business, and which is our bread and butter because we are doing from years. And then 40% odd is around SBL, small business loan, which we are all talking about. Is it the roadside, kirana shops, service centers, computer shop, whatever, right? It's more of an MSMEs, micro, small enterprises. So we cover them well from last 10 years. We also restarted our housing. So these are three prime products which we want to really build AU. Other than that, we do the commercial banking around business banking and agri banking. So these two verticals are also coming up. And there we actually service on the basis of balance sheet, right? So there has to be a tier 1 kind of customer, but might not be a customer who go to the higher banks. It's a customer which we can actually engage and can do service. And then, of course, the smaller one like PL, the gold loans, maybe consumer durables, and maybe some affordable housing projects. So they will do because of the branch banking affinity, because a branch banking customers, a customer who gives you liability, somehow looking for a small personal or small tenure, might be looking for a gold loan, might be looking for consumer durables, right? So they will do a very small proportion. So
how do you meet your agri targets under PSL?
Yeah, so entire wheel book, which is close to 75% wheel book is priority sector. The SBI 75% is priority sector. the business banking, the SMEs and MSMEs is private sector, right? And we also do the agri banking. So our agri book, agri classification comes from agri banking book, and of course, whatever the subclasses, the sub use of the wheel book and SBL, because SBL means that if a customer is agriculture, right, and he requires money to build his own warehouse, or he requires a tractor, or he requires something there, that is classified as an agri. So we are not in direct core agri, because as you all, SAB don't have that benefit of interest subventions, so which senior banks has. So we actually get discouraged on the ground to lend around the what you call the KCC. So, but we are evolving ourselves. So, but other than microfinance, honestly, I do everything. And as Paul Saab commented earlier that you do what you know, right? So we are really focusing on that. And in journey, as I already told, is journey of infinite. So we will do microfinance as we get more matured, our balance sheet get more strength, and I meet Rajiv more and more, right? Because I don't meet Rajiv more and more, so that's why I don't get. So yeah, so I think that's the way I do it. But I think Bindu, the larger part of asset, as I already communicated, that for me the financial inclusion happens once you do loans, and loans to the business people, right, who earn the money. So the AU focus always remained that our loan should be productive. People should earn. So like once we started our journeys in NBFC, we were doing for the taxis. So the people will actually started with one taxi, and after 20 years of my working, 25 years of my working, people have taken 5-6 taxis, right? So that has given them extra money in their family. They have taught their children, and they are so well do now. So that's the whole idea of a banking, honestly. So, so we believe that the design of a bank, design of SFBs is also to allow customer to grow with you, right? And I'm very proud to say you that AU has done tremendous job in the last 25 years around our sector, right? And microfinance, unfortunately, we were not there, so we don't have the confidence, but maybe in years to come.
No, fabulous. Thank you very much. And like you said, these are, hopefully 100-year institutions that you're building, and this is just 5 years. 500. Got it. We have really good questions from the audience, so I want to dive right into it. Abhishek from Axion asks, do SFBs feel that they are at a disadvantage in any way relative to a universal bank, or actually have advantages? How important is it to have the universal bank in the long-term strategy? If I can ask Rajiv to quickly respond to that, and then I want to get to more questions.
Sure. I would say, we have enough of a regulatory space to build the bank that we are building. As Sanjay said, an NBFC was a very small organization in terms of its complexity, and this license gives us enough to work on the deposit side, enough to work on the asset side, the payment side. And a lot of times it's all about specialization. And so in the short term, 5 years, 10 years, I think there's enough to do. The opportunity to convert may come early, and each one of us will take a call because there could be some strategic advantages of converting to a universal bank license, some of the regulatory framework. But if you ask me, a lot of us, are quite confident that we have enough of a regulatory space to sort of, operate and do our loans. In terms of advantage and disadvantage, I think no major disadvantage. They are doing what they do well. They are the large banks. They do corporate loans. They do investment. They do all kinds of things. And the space that we operate, we were not competing with them when we were an NBFC. We're not competing with them a lot in the asset side even right now. In the deposit side, there's enough to go by. So I would say there is no major competitive advantage or disadvantage. There is enough to do. The license gives us enough space. It removes a lot of risk which come because we are deposit taking. So it has cushioned us against those risks. So enough to work with.
Excellent. Thank you.
Just to add on this, there's a famous saying, is a half full glass, right? So what you want to see is your own way to see it. So I will say there's a glass half full, right?
Right. And I think to Rajiv's point, there's just so much to do. And it may be that RBI is looking at this as a bit of a funnel strategy to say the banks of the future have to come through successful execution on the SFP. So, some may be universal banks of the future, but it certainly seems like there is more than enough ground to build, very valuable SFPs. There's a question for Sanjay from Misha of Dwara. Has AU thought about innovative savings products that appeal to low-income households in addition to the overall current liabilities? Do you think that's feasible? Is there a way to design good savings products for the informal segment?
Yeah, so again, I will say that because we are just started our journey, right? So, and we are just learning how the deposit will come and from where it will come. So, and the market which Nisha, right, is indicating is not easy because I personally believe that households should have some more income level to do some saving, right? So I would rather focus to do them loans. And of course, because generally people say they don't have a saving habit. It's not like that, honestly. They don't have money. And if they have money, they want to actually look for a better returns. And we, unfortunately, as a bank, only gives them 5-6% by design. We can't build our own rates or our own products. It's very, very regulated. So
I think the other point, just to add to that, Sanjay, in rural, overall, not just low income, but rural, a lot of the assets are actually held in physical form. So you have house, land, these are 90% of balance sheets of household. So unless you find a way to, in some sense, convert the physical into financial, just your cash flows are not giving enough surpluses, right?
No. So I completely understand. So I would say that the world has moved a lot in last 10 years, So every asset, honestly, the customer has is mortgageable. So we are doing that SBL loan is on the Gram Panchayat, on that all those properties where people can actually get the loan against that. We're actually lending them money through various schemes of government, through credit guarantee schemes or Sunidhis and all those stuff. So I honestly don't believe that there is a lack of finance. It's a lack of opportunity to how to make your life more cash surplus, right? So I know the people have naregas, people have a lot of other aspects, but unfortunately, our per capita income is so low that whether people really want to use for their own consumption or they really want to do for savings, But I would say we are in journey. We are reaching there through our different channels, whether it's in BC, whether it's in BO, whether it's in branches, and that's our duty also as a bank, that we should be present in those markets, explain them about products, build a delivery model which is easy, convenient, and because they need to be very understandable also. And you will appreciate that bank only works around 23-4 days, so those people actually get vulnerable because bank is off, bank is on holiday that particular day, so they don't want to keep money because we don't have ATMs everywhere. So I think the whole work is in progress, and I would say SFBs in next 10 years will play a very, very important role to build a very decent franchise around these markets. That's our duty, that's our whole design also. So we appreciate that, if somebody helps me out to build some product, we are very open to that. And we are doing
I'm sure Misha will take you up on that offer. Question for Henrietta from Henrietta of Habitat Microbuild. Has your institution been able to tap into your existing microfinance customer base for other products? Paul, if I can turn to you, you already spoke a little bit about it to say two-wheelers, housing, etc. In general, what's been that cross-sell experience on the asset side?
Yeah, it depends on the cash flow. We are giving the other loans based on the cash flows of the customers. So we made products available to them. We did continue to do focus group discussions with our micro banking customers on a monthly basis. But personally, I am attending those meetings now. because of the pandemic, people are also well versed with the online platforms, so that it's easy to have these discussions, and we are understanding their requirements, and we are modifying our products. So we have a micro housing loan product, we have a two-wheeler loan product, a micro enterprise loan. So all these products are mostly designed for the existing customer segments. So, there are many cases. People are slowly graduating. So I can just one customer always comes to my mind from Nelambur in Malappuram. So she has started with a 20,000 rupee loan in 2012. So she started a micro business of making floor mats by cotton waste, with the cotton waste. So her business has grown. 2 years before, she has taken a 6 lakh rupee micro business loan from us. She built a shed. She is employed 20 people. She gave employment. Then a few months back, she asked for a housing loan. We sanctioned a 13 lakh housing loan to her. So that is a story. So we have the products ready, and we are working with our customers, making awareness. And financial education is very important to this set of customers. Help them to plan for the future. And all these assets are their reverse saving, actually, as you rightly said, Bindu, earlier. So that savings is mostly on assets.
Right. Very insightful. I want to take 2-3 questions and kind of combine it. We don't have time for a response, but I'll just share with the panelists that there's a lot of curiosity about who do you think of as competition, particularly because you have a different play on the asset side, different play on the liability side. So there were at least 3-4 questions. Unfortunately, we don't have time to get to it, but around understanding the competitive landscape. And it's interesting that you are actually straddling multiple, institutional types, and therefore your competitors also will vary. We have just about 2 minutes left, so obviously wanted to talk a lot more, and it's been fascinating. But a few things that I definitely took away was a sense that the 5 years has been truly blood and tears and just getting things off the ground. And the strategies that we see today may not be the equilibrium strategies, particularly with respect to products and branches. A few of you said that you expect a little bit more convergence, going from the Robin Hood strategy to a convergent strategy, potentially around the semi-urban market, not so much the core rural, although there will be continued overlaps. And of course, there was a lot of emphasis on learning as you go and just sort of imbibing all of the innovations that come along the way. But a big congratulations to all of you for making this journey, and to your teams for executing so well. I think the audience will agree with me that as we look at the post-COVID landscape, the fact that we have 10 solid institutions in the SFB category and many NBFCs, of course, I think the recovery for the informal sector will definitely be, everything else remaining equal, better because of the fact that they can access institutions like yourselves. So thank you all for sharing your thoughts and time so generously. And I also very much want to thank Access. In a year and time when everything is changing, I think it's almost comforting for us to be able to get together on this forum that has been so successful over the years. And it was a real pleasure to moderate and meet all of you. Thank you, Arya. Let me hand it back to you.